Good evening, everybody. John Harris here, managing partner with Fortune Management, and it is a pleasure to have two good friends and colleagues of mine, Mr. Bill Barrett with Mandelbaum Salsburg, and then also Mr. Mark Murphy, who's having some technical difficulties with Wi-Fi and phone, so he may be in and out for just a few minutes here at the very beginning of our discussion this evening. But both of these gentlemen are a wealth of knowledge, experience, and information when it comes to our topic for discussion tonight, which is mergers, acquisitions, associateships, and DSOs. And so we want to go deep into this subject, covered as in depth as possible. And when I thought about putting this event together, we've done several of these. I couldn't think of anybody better to have included in this conversation the two gentlemen I have on this evening. So excuse me for not mentioning that, but Mark is with Northeast Private Client Group, which is a financial advisory institution. And then Mandelbaum Salsburg is a very large and comprehensive legal firm out of. Are you guys located in New York, Boston, Northeast?
We're headquartered in northern New Jersey, and we have offices in New York, Colorado, and Florida. But we transact all over the country.
Very good. Okay, so national organization there. I imagine you've got clients in Canada too, don't you?
We don't have Canada. Have Canada.
Okay.
We have Canada, actually. We have a few clients in Canada.
Do you?
It's a weird deal, but they've got to have some U.S. bank accounts and that kind of stuff.
Gotcha. So both of these gentlemen have done hundreds and hundreds of transactions with dentists across the country, from coast to coast. So again, wealth of knowledge, experience, and information, and I'm looking forward to tapping into that a little bit this evening. So again, if you've got any questions, feel free to use the raise your hand feature, or feel free to put your question into the chat, and I'll be more than happy to present that to the panel. And with that said, let's jump into our conversation this evening, guys. So the first thing that I've got on our agenda is to kind of break down evaluation strategies. So there always seems to be a little bit of confusion around this. You'll hear people talk about a percentage of revenue. You'll hear people talk about multiples of EBITDA. And then there's some confusion, I think, between EBITDA and discretionary earnings and what the multiple looks like, because those two numbers are very different. It also looks very different if it's a DSO, and what that offer looks like compared to a private practice owner who's going to step in and do the dentistry. All that stuff looks very different. So I'd like to kind of really dive into that and help our listeners get a really comprehensive understanding of when they hear people talking about the offer that they've gotten. For example, I've recently had a client sold his practice to a DSO, a dentist-owned, smaller DSO, so not corporate. And then I've got another client who was recently presented an offer that was very strong. And so that we're taking that in consideration at the moment. So these numbers get float around, right? We'll hear, I got a double-digit multiple of EBITDA, or a double-digit, multiple of this, or this percentage of revenue. So I'd like to really dive deep into this and really give our listeners a really deep and comprehensive understanding of, depending on what they hear in the market, what do those numbers mean? What do they need to know to be able to interpret and comprehend what that offer actually is?
Okay. Well, I'll start if you like.
Sure.
I mean, historically, I've been doing this for 23 years, done about 1,000 practice transitions all over the country. And historically, practices were valued as a percentage of gross receipts, generally speaking, looking at the last 3 years, and there'd be a weighted average. So, for example, you would take 3 times the most recent year, 2 times the year before that, 1 time the year before that, divide by 6 to get the average, and you'd multiply by a percentage. And that percentage would vary depending on the type of practice it was. So, for example, if it was a high-end fee-for-service practice, you might be as high as 80 to 85% of the average of the 3 years of gross receipts. If it was a kind of a traditional general dentistry, a little bit of PPO and some fee-for-service, kind of like your classic American, solid practice, somewhere in that 75% of gross range. Practices that were heavily driven by insurance or have like capitation plans or Medicaid would slide down more to that 60% and sometimes even a little below that. And, and that's kind of the way practices had been valued for a long time. And still today, in doctor-to-doctor transactions, it's not uncommon to see those methodologies or similar methodologies utilized. What's kind of thrown things around a little bit or turned it upside down in terms of expectations is that DSOs have really become more and more prominent on the scene as acquirers of practices, and their approach is different. They're looking at EBITDA in terms of like what actually falls to the bottom line in a profitable practice that's going to create a return on investment for the DSO or the private equity group backing the DSO. And sometimes, not all the time, but sometimes when you do that calculation of EBITDA and then you add a multiple to it, and I'll explain the real range on multiples because there's so much fiction out there about what's really happening. But depending on what that multiple is, you might end up at 100 or 200 times, 200% of the gross, or 100%. So sometimes with depending on the multiple and how EBITDA is calculated, it could push the valuation higher. So that's kind of thrown off expectations. But most DSOs are not interested in small practices, right? They're not interested in practices unless they have a nearby location that can easily fold that practice in. So a lot of times they're looking for bigger practices where, frankly, there's more meat on the bone to be able to generate a return on investment. So with those types of practices, larger practices, yes, you're seeing that as a result of the formula concept that they'll use to value at the DSO level, it'll drive up a higher valuation and sometimes materially higher. But there's still a lot of deals being done in the traditional manner, and smaller practices, when they are acquired by a DSO, get a much smaller multiple. So I'll give you a flavor, John, on the multiple concept, because people throw this concept about multiples around, and we see scores of letters of intent from all different DSOs around the country, large, small, medium, and we have a real good sense of the multiples that are actually being offered and paid. And for a single standalone practice, you're talking about a multiple somewhere between 4.5 on the low end of EBITDA and maybe 6 or 6.5 times on the high end for a single standalone practice, and even a fairly sizable one. When people have a standalone individual practice and you hear them throwing things around about 10 times the EBITDA multiple, that's fantasy land. That's not really happening in the marketplace. I mean, there could always be an aberrational scenario, but out of the dozens and dozens of deals that come across our desk, we don't really see that. You don't get into those kind of high multiples where you get to a 10 or 11 times until you've got many locations under one brand. So we have a client right now, very profitable oral surgery group with like 12 locations, all under one ownership, all under one brand, all integrated, and that's yielding an 11 times multiple. So it gives you a flavor for what it has to be.
Very good. Why would a DSO be interested in paying? Because that's one of the things that's driving the price of practices up in the market is DSOs are paying more for practices than what a private practice owner would. Why are DSOs so willing to pay more for practices?
I think I would take that. I think, John, every business other than dentistry until the last 4 or 5 years was sold on EBITDA, was sold on profitability. And so the reason you see professional money coming into the marketplace, professional money being private equity, Wall Street, hedge funds, et cetera, I mean, the entire world is becoming, I'm meeting more guys every day who have researched this industry and didn't know where to put their money and are landing it. They should invest it in dentistry. Because when banks are paying about 0.4% taxable, if you want to keep your money in a bank right now, DSOs and people investing in dentistry are earning 20, 25, 30, sometimes 40% on their money. But let's just use the low end of it. Where can you put your money and get a tax-deferred return of 20% plus on your money, cash on cash, and have an asset that's growing? Pretty attractive place. Mm-hmm. And also because, in fairness, most dentists, I know a lot of your clients, John. Most of your dentists are not only the great artists, but they're either they're either great CEOs or you're teaching them how to become great CEOs. But most dentists are not that. Most of them have bought themselves a job, and I think smart money, let's call it, or Wall Street money or private equity money, has seen that and has come in and filled the void, much like they did in medicine or another place or in other spaces like that.
Mm-hmm. Can you, either of you two gentlemen can take this one. Can you speak briefly on because I've seen multiples presented as a multiple of discretionary earnings. I've seen multiples of EBITDA. Obviously, we've seen percentage of revenue. Can you speak? I think everybody's clear on percentage of revenue. Can you speak on the difference between a multiple of discretionary earnings versus EBITDA?
I'll pitch that one to Mark, our financial guru.
Well, I've even got a platform that I use.
I think I would put it this way, John. I think there's probably two groups of folks that we're working with. I think the first group of people that may be on this call, because I don't know everybody on the call, but I think it's two groups, or it's a couple of groups. First group would be, I'm thinking about selling my practice. Am I better off selling it to another doctor, to my associate, or am I better selling it to a DSO? And again, we can go into the nitty gritty of this today. I think Bill would love to tackle that subject. I know I would. And for the answer is, we think for some of our clients, I think it's a minority percentage, they are better off with a DSO. But there's a place for everybody to be able to do that. Because remember, there's sometimes what's a shiny object is not real. Sometimes a multiple is not what it appears to be. And I think we'll go into the nuances of what that means. It could mean things like, how much money do you have to hold back? Are they buying 100% of your business at that value or a percentage? How long do you have to work for, and how much are they paying you to work during those years you're working? There's about a dozen or more factors that you have to look at. And I don't think there's a free lunch. So I would say for most of at least my clients, the DSO route to sell is not the best route, but it is for a good percentage of them. I think the other group is the second group is to try to figure out, I'm either looking to buy into a practice or buy a practice from another doctor, or I'm looking to sell a piece of my business to another doctor. And I think, one of the things about that is, what's beautiful about that is that there's banks in this country, because the loss rate on dental practices is darn near zero, John. Dentists have special lending rules. Interest rates are at historic lows, at least right now. And banks are willing to lend people at very, very advantageous terms, which allows not only the seller to have the buyer to have a reasonable payment, but the seller can also command more for the practice because the buyer can borrow more based on those interest rates. And so I would say that those are two of, I'm guessing that on this call, most people fit in one of those two categories.
Yeah, I've got a platform that I use, because I'll have Patterson reps and other folks that'll reach out to me and say, hey, I've got a doctor want to know what his practice is worth, et cetera. And generally, I like sending those guys over to DDS Match. I've got a couple of good friends there that do a really good job with practice evaluations. They use an accounting firm, Blue & Company, and I really like their evaluations. They're very comprehensive and in-depth. But just out of interest, I started digging in and learning more about the subject myself. I've got a platform that I use that provides me national level data of business transactions in all industries. And I can filter that down to just show dental practices between $600,000 and $1 million in specific areas of the country. And then it breaks market value down, fair market value down into three categories. And it'll show you, based on what the practice sold for, it will show you it sold for this percentage of revenue, it sold for this multiple of SDE, or seller's discretionary earnings, and it sold for this multiple of EBITDA. And from what I understand, I'm not an expert on the subject. From what I understand, your discretionary earnings are essentially EBITDA with the owner operator's income added back in. And so your multiple on your discretionary earnings is going to be a little bit lower than your multiple on EBITDA. So, like, for example, a DSO buying a practice, they can't go in and do the dentistry. They're looking at specifically the bottom line. I'm going to have an associate in there getting paid. And then after all of that's paid, then the number that falls to the bottom line are the earnings left over before interest, taxes, depreciation, and amortization. That's the number I get to determine how I'm going to spend it. And so they're focused more on the EBITDA number. Whereas if I'm a private practice owner and I want to buy Bill's practice, or if I'm a dental associate and I want to buy Bill's practice, I'm not so much concerned about EBITDA as I am discretionary earnings. What am I actually going to make as the owner? And so I think that's where some of the confusion comes in, because you'll see a multiple of EBITDA that's, 7, 8, 9 versus a multiple of discretionary earnings, which is 2.5 on the same practice. It just really depends on who the offer's coming from. Does that make sense?
It might, but I'll be totally candid with you. I literally closed DSO related transactions, in the hundreds over the last 23 years, and the analysis has always been based on a multiple of EBITDA. I haven't seen valuations on discretionary earnings as, at least on the deals that I've handled. And as Mark said, there's a lot of strings attached to these transactions. Sometimes they do yield a very high valuation, but what percentage of the valuation are you going to be required to hold in the stock of the parent company that's acquiring you? How many years are you going to have to work? I have a deal going on right now where the doctors are a little older. They were hoping to be able to leave within 3 years, but the DSO made them a very nice offer, but is insisting on 5 years in order, before they're able to stop employment. And they've taken a piece of equity and created a vesting period. So if they don't stay for the 5 years, they effectively would lose the equity. So it really puts the handcuffs on them to stay. So sometimes, the deals can be very robust, but there's a lot of strings attached. And one of the issues that happens sometimes, a practice, I love strategies. I know you do too, John, about bringing in associates and minority partners, and which is a great strategy. Sometimes practices get so big that when someone is seeking a liquidity event, they run out of options other than a large DSO, because if they really want to maximize the value and they've gotten so big, a young associate or even 2 young associates aren't going to be able to go get a $15 million loan from Bank of America to buy a practice. They might get a couple of $1 million, and there's tons of, as Mark said, tons of great money out there at great rates and very available to these doctors to make acquisitions. But a really large practice or multi-location practice where, all of a sudden it has a valuation of $15 million, that's going to be very difficult for anyone other than a large group to acquire.
Yeah, I think the discretionary earnings, I think the interest in discretionary earnings is going to be almost specifically private practice owner operator acquisition. And I'm looking at it like, if I'm fixing to buy a practice. So if I'm going to buy your practice, let's say I'm making $175,000 a year now as an associate, and I want to buy your practice. Okay. Well, you're getting paid something to do the dentistry. So my concern is, can I buy that practice, cover the liability at the bank, and make what I'm making now? Right? Because my cost of living is built on my income now. So if I can buy that practice without taking a cut in income, and it covers the liability at the bank, and now I'm getting paid the same thing I'm getting paid, but I've got an asset accumulating value on balance sheet, that's a home run. So, but I may be willing, depending on what I find in that practice, that may have significant growth potential. So I might be willing to take a little bit of a cut in income if it's going to mean my income doubles in 2 years, and I've got the same asset that's growing at 30% year over year. So I can see that. I can see that being of more interest to someone who is in that situation, who's interested, like a associate dentist who's fixing to buy their first practice. I want to know, what's the total amount of money available for me as the owner operator to make sure all the bills are covered, and make sure that my personal bills are covered. And how does that number compare to what I'm making now as an associate? That's kind of how I see that.
I mean, well, that's really structuring a pro forma, right? That's basically backing into, what is your life going to look like post-closing? And, once you become the owner, whether it's full owner or part owner, and you all of a sudden, you have the profitability of hygiene and other things, are you going to be able to cover the debt, and how much are you going to make? A lot of times in those deals, the senior doctor needs to be phased out, or the doctor being acquired needs to be phased out sooner rather than later, because the acquirer wants to pick up that dentistry that they're doing, in order to make not only as much, but hopefully more while they're also servicing the debt. So a lot of times in those deals, you do see the owner transitioning out a little bit sooner, for the other doctor to be able to start to pick up more of the dentistry, or to change their schedule and start phasing down a little bit over time so that they can, be able to do that analysis and in real life, make more money than they were making before while they're also servicing the debt. And that is, an analysis I know that you do when you have someone doing a minority partnership and buying in. You want to be able to show the associate, obviously, that, hey, if you buy in, even after you service your debt as a partner, between what you do with your own two hands and your percentage of the profits as a part owner, you're going to actually service that debt and make as much or hopefully a little bit more than you were before.
Mm-hmm. Yeah. One thing that's really interesting to me in the whole acquisition space is the subjective nature of that multiple. Like, who tells you whether it's 5 or 6, and what has to happen for it to become what has to happen to move the needle from 5 to 6?
Yeah, but I think, John, it's also a basic negotiation, meaning the seller always wants to pay the lowest multiple and the buyer wants the highest multiple. And I think what's getting a lot clearer, though, is what EBITDA really is. You kind of mentioned it before, but if you use a general practice as an example, if you have a doctor that did $1 million of dentistry, and I only say $1 million, that's a big number. I only say because I can do the math late at night, and you pay that doctor 30% of collectible production, and that doctor's salary is $300,000. But let's say the doctor showed on a tax return a $500,000 income. Mm-hmm. Well, that means $200,000 is in profit. But then also we would do what we call add backs. We'd add the doctor's car back, some of the T&E that might have been a little questionable, some of the cell phone, some of the what's called personal expenses that the IRS allows you to deduct from your bill, from your taxes rather. And so you add, let's say that was $50,000. So you add that back. So the doctor's salary as a doctor is $300. The profit is $200. The add backs are $50. So the profitability of that practice is $250,000. That's what the multiple is going to be based on, because that DSO is going to have to hire somebody and pay them $300,000 a year to do that $1 million of dentistry.
Correct.
And you do the same. And you do the same analysis. Now, what I think Fortune has done so brilliantly over the last 30 years, in my opinion, is what they then do is most people are not buying a practice to maintain it. They're not buying a practice to, kind of hopefully hope it only atrophies a little bit. Mm-hmm. What you guys are doing, going in there, is going full guns ablazing and figuring out where all the opportunity is, so you can take that practice and take it to the next level, so that buyer is not buying the existing cash flow. They're going to buy a much higher level of cash flow by doing, you can name it, John. There's probably 4 dozen things that are your go-to moves that help that practice that was doing, I'm making up a number, $2 million a year, and now you're going to help them do 2.5 or 3 or 4 or $5 million, and that's how they get return on their money.
Mm-hmm. That's precisely that's probably my specific area of interest, is in that space. Like, for example, you'll take a practice and on paper it's only worth $350,000, right? Like, you do the math, you send it to a broker does the evaluation, sends it back, your practice is worth $350,000. I like going in and looking at the information, looking at the hygiene schedule, looking at the treatment that's being diagnosed, looking at the fee schedule and the insurance reimbursements and the perio and all that stuff. And I like saying, okay, yeah, on paper, the practice is worth $350,000, but if they just push these 5 buttons, that practice would be doing 1.5. So it's really not worth $350. It's really worth what it would be worth if you were doing what you should be doing. So that area, and how confident are you that you can mitigate those risks? For example, undiagnosed or or perio that's not appropriately billed, right? We've got to fix that. That's a liability. That's a risk. But if we bill it out correctly, then higher fees, that's a return. Fixing the fee schedule, insurance strategy and renegotiation of insurance reimbursements, reactive treatment diagnosis. And the other big one that I typically see is mismanaged hygiene schedule. They've got 2 hygienists. They can't get a patient on their schedule for, 4 months. and they really need one or two more hygienists. I mean, that's a significant growth potential.
How about increased capability, being able to do implants from soup to nuts, or perio, or Invisalign, or I mean, there's just having more capability and being able to do more procedures than the current doctor does.
Yeah, that's another one. And so it's really neat to dig into that information and look and see what all's there, and try to project what you think the return can be, like what your strategy is going to be when you take over and what you project that practice being able to do in the next 12, 18, 24 months. Because if it can do a lot more, like if you're sitting on a lot of potential, then, I mean, you might be willing to pay a little bit more because you know what that asset really is. It's like Warren Buffett's number one piece of advice is know the real tangible value of an asset and buy it when it's on sale, essentially. And so I see that as, a practice that should be doing 1.5, it's only doing 700,000. That's a $1.5 million asset that's on sale. So it makes a lot of sense. And I think it's interesting that, Bill, you said that DSOs are going after your bigger practices that have more profitability so they can recoup their investment faster. I think the practices that these private dentists should be targeting and building their enterprise are the $600,000 to $800,000 practices for a lot of them. Because those are the ones that are in the suburbs around the major metropolitan areas. They may not be as profitable, but those are the ones that are sitting on the most growth potential. So I would rather buy it for less, know what I'm doing, and grow it and ride that return.
Yeah, and the good thing about that is, the doctor looking to be an entrepreneurial doctor and grow and expand their business and scale, there's going to be less competition for the practice you just described, right? A lot of upside to grow it and maybe more than double the size of it. But you're not going to be going toe to toe with somebody who's probably overpaying. Like I said, a lot of times those practices, the only time you rarely see DSOs go after those practices unless they have kind of a large facility nearby where they view it as an acquisition that they can just roll right in to that facility. But short of that, the practices like you described, they're mostly, in my view, they're staying private, and it's a great opportunity for doctors who are, in support of the preservation of private practice dentistry and want to scale and grow. Those are great targets.
Mm-hmm.
So I think what we're saying is that if you're the buyer, you want to buy that undervalued asset, buy it now, and help have you a guy like you, John, grow it. And if you're a guy that wants to sell your practice in 2 or 3 or 4 or 5 years, they ought to go grow it and then sell it at the higher value. Mm-hmm. Why would they not put the work in to take that $700,000 practice in your example and spend a couple of years getting it to $1.5 million and then sell it?
Yeah, and a lot of times it's really not big things that need to happen. I mean, if people understood how easy it is. Because a lot of these doctors, they don't want to, when they get a little bit later in their career, their mortgage is paid off, kids are out of school, they don't have the same pressure to produce that they did when they were a little bit younger. And so what happens is that they kind of get comfortable with the revenue stream that's coming in, and they stop reinvesting, and they stop, growing the business. And it just kind of plateaus, right? Well, nothing really stays flat, right? It's either growing or it's dying. So when you pull your foot off the gas pedal, it immediately starts to take a turn for the worse. Maybe a slow turn, but it's still a turn. And so if they realized that just hiring that hygienist, if it's warranted and if the numbers suggest you should do so, just hiring that hygienist, I mean, your restorative schedule is going to do, $2.50, $3, depending on every dollar that comes out of hygiene. So you can imagine adding an extra column of hygiene, what that would do in terms of total practice production. You're looking at 15, 20, 25% growth in the practice as a whole. And all you did was hire a hygienist. I mean, if they understood how easy it was to do some of those things, I think they'd be a lot more proactive in keeping their business on a healthy trajectory until they reach the point of, looking for a transaction.
Yep. And I'll throw in there too that I think COVID has actually helped create a lot of opportunities. There's a lot of doctors I've seen who were contemplating a transition, and in their mind they were thinking maybe in the next 5 years, but they were starting to already feel like maybe they're towards the tail end of their career and they're thinking about transition. What I've seen with a lot of doctors is that COVID, for a host of reasons, made them speed up their timetable, where some just didn't want to deal with the health risks. Others didn't want to necessarily have to make the investment, the financial investment in a lot of things in the office to create the environment that was going to, be the ideal environment in their office. So I think that it's actually created opportunities for entrepreneurial doctors to, as you said, some of these practices are undervalued because they have so much upside that's not being tapped into.
Well, do you guys have any insight as to the essentially, for lack of a better description, condition of the market at the moment? Like, we still got a lot of baby boomers who are practicing dentistry. So there's still a big chunk of, a large percentage of the market is still on that tail end that is either currently looking to transition or will be looking to transition in the next 5, 10, 15 years. Is there anything that these guys need to be aware of? Like, when that 5, 10-year period's over, is the opportunity just going to die, or is it going to continue to, be available maybe on a more limited basis? Because that's one of the biggest demographics in the history of mankind. So that's going to be a significant portion of the market that exits.
Yeah, and I think that's why, frankly, you see a lot of consolidation going on right now, because there are a lot of practices on the market. Transactions are at a fever pitch right now. There's a lot, between the fact that you have baby boomers starting to reach retirement age, you had COVID, you have some people that have been motivated by their fear of a tax bill that might be, less than ideal. And we don't even know what's going to happen with that yet, between, whether it happens or not before the end of the year and what it looks like. No one really knows, but there's kind of an assumption by a lot of people who were thinking about transitioning that, okay, whatever's going to happen is probably going to happen before the end of the year. And it's probably going to involve taxes going up, not down, right?
There's no risk of that. Taxes are not going down.
Right.
They may or may not go up, but they're definitely not going down.
Yeah, and so John, what I'm seeing is the busiest market that I've ever seen. There's just a lot of activity right now. Taking all those factors and putting it together, it's created a scenario where there's a lot of people who have moved up the timetable on their transition plans. So it's very busy out there.
Yeah.
John, one of the things, because we wrote a book on that 4 years ago. Bernie and I wrote that book on mergers and acquisitions. And, to me, you break it down in the simplest form, and I try to keep it as simple as possible. If you've got $1 million practice, and typically $1 million practice has a 70% overhead, that doctor will take home $300,000 a year. Some do a lot worse, some do a lot better. But let's get the average $1 million practice, they take home 30% with a 70% overhead. If you can buy the practice next door and merge it into your facility, and let's do some numbers here. Let's assume that it's 2/3 surgical, 1/3 hygiene, and you paid that doctor 30% on the surgical piece. Either you do the work, the selling doctor does the work, one of your associates does the work, but you got to pay some doctor 30% of that collectible production. If you do the math, it costs $195,000 of that second million goes to the doctor. And let's assume we just did a 5-year buyout at $150,000 a year for 5 years. And at the end of 5 years, there was no more buyout. We had an accelerated buyout and did it just over 5 years, which is, going to really hit your cash flow hard. But let's say we want to get it done and over with in 5 years. That means your hard costs are $195 to the doctor, assuming you're not doing the work, $150 to buy it out for 5 years only. If you add those two together, that's $345,000. You've collected $1 million. That means your gross profit is $655,000 on that second million. Mm-hmm. And all you have is a few supplies and maybe 2 or 3 employees. We're seeing our average practice put between 45 and 50% of that second million to the bottom line. So let's use the low number. 45% is $450,000. We've now taken a doctor that was making $300,000, and now they immediately, with little or no risk, are now making $750,000 a year. Mm-hmm. They're not complaining about their income tax, And that's before we talked about doing all those turbochargers that you talked about, earlier, 15 minutes ago, to take that million. So now we take them from 750 to $1 million or $1.5 million or $2 million. And that's not collections. That's what they're taking home. My favorite thing, John, in the entire world is to talk to a doctor who's worried about this, worried about that. And within a year or two, all they do is bitch about all the taxes they pay. Mm-hmm. So I love it. That there's nothing makes me happier than to see people complaining about income taxes, because that means they're making a lot of money.
Yeah. And that's if you bring the doctor with the patients. If you just let's say that you're not busy and you buy the patients and bring the patients in, you're probably dropping 65% of every dollar to the bottom line.
Absolutely.
So,
yeah.
Which that's the great segue, Mark, to to our second topic for discussion this evening on the merger and acquisition. I hear a lot of people look. Matter of fact, I had a coaching call with a client right before this call, and he's got. I read through a couple of practice evaluations that were presented to him by CPA, and I think the CPA is representing a couple of private practice owners, and both of these locations would be second locations. He's got another potential deal down the road that would be a merger. And so what would your advice be to someone considering what makes the most sense in your opinion? Does it make more sense to merge? Does it make more sense to add a second location? Is it revenue dependent? Is it strictly money dependent? Are there other variables they need to take into consideration?
Well, I could take that a little bit of that. For me, I think that initially building out a mothership facility, in my opinion, is, and reasonable minds can differ on this, but I think that building out a mothership facility is a better way to go, because you have a certain amount of fixed overhead. Mm-hmm. And the more that you can build out in one location and add, even if you make acquisitions and then fold them into that location, in addition to your organic growth, you're going to have more money hitting the bottom line, because even when you add another $1 million of top line revenue in dentistry, you're not necessarily hiring another person at the front desk. The mortgage or the rent, whatever it is hasn't changed. Mm-hmm. The utilities haven't changed. There's a lot of constants that don't change, but you've now added $1 million of top line revenue. A large portion of that's going to fall to the bottom line. Mm-hmm. Even if you try to centralize and try to run yourself, really, really tight, when you get to multiple locations, there's going to be certain, redundant expenses just by virtue of having different locations. Mm-hmm. And some of the things I mentioned, insurance costs, insurance costs for one physical plant, it isn't going to change because I added $1 million worth of top line revenue. So but if I add locations, there's going to be rent or a mortgage at every location, mm-hmm. utilities at every location, insurance at every location. So, and I love building out an enterprise with multiple locations. But to answer your question, at least in my view, when you're looking to do kind of that first one and you have a choice, do I build out this facility or do I buy another facility? I would probably lean towards building out further the initial facility.
Yeah, I think Mark kind of gave us the answer to that question before I asked it, because he gave a really good example of buying a practice, and $1 million practice with 70% overhead, 30% going to the owner doctor, right? Well, if I buy that practice as a second location, I'm in this location, I got to pay a dentist to do the dentistry over there. So maybe I'm dropping 10, 15, if I'm lucky, 20% to the bottom line after the dentist is paid. Whereas if I merge that patient base into my existing practice, even if I bring the doctor with me, I'm getting twice as much money. I'm driving twice as much money to the bottom line. So I agree. I think it makes a lot more sense financially. And I think strategically too, because it's more difficult and it's more headache and it's more stress to manage two locations than one. So you're getting paid less money and you're working twice as hard. So it makes a lot more sense to get a raise and, not work any harder than you're working now, which would be the merger option. Does that change? Does that change if the second location has real estate?
What do you mean? Does it change if it has real estate?
Let's say that I have a practice and it's got to be a second location. It's too far away. Maybe there's some land barriers that patients don't want to cross. but I have a practice and I want to own multiple practices, but I'm currently leasing. And I've got an opportunity to buy a second location, and that second location's got a pretty good piece of real estate attached to it that's for sale. Does it make sense then? Does that make more sense then to choose the second location over potentially a merger? Let's say I can only do one.
Well, I want to let Mark talk about a little bit about this too, because I know he's written about it. But I mean, I'm a big believer that when you have an opportunity to own the real estate and have that asset, that you take advantage of it and create an additional asset rather than, have rent going towards rent and not creating any new equity or value.
Mm-hmm.
Owning the real estate is another asset for you, throughout your career. Even when you get to the point of selling your practice, it could be, a stream of rent or just another asset that you sell. I don't think that each has to be mutually exclusive of each other. Whether one is good or bad, but one may be better than the other. If that makes any sense. Mark, you're muted.
I was just going to say, Bill, is it's a different business model, and as John kind of pointed out, owning multiple practices, you're only one person. You can only be in one place at a time. So I think part of the thing you have to do, John, is when you own multiple practices, you got to not only be really organized, have a great management team, great culture, and you got to have really people that get it, want it, and have capability. But you've got to be able to let go of the vine, because you can't be in both locations at both times.
Mm-hmm.
So it's a different business model. So even though most of our clients, or many of them, have multiple locations, I don't encourage them to get. I'm not the one saying you should buy a second location, because it's a different business model going forward.
Mm-hmm.
And I think in terms of the real estate, I'd add one more thing is, whenever possible, we want our clients to own the real estate. And it makes especially sense in dentistry, because if you occupy more than 51% of the space, you can get 100% financing from some banks. And if you take a look at the tax code, John, a number of years ago, they started to accelerate your ability to depreciate real estate. So where most people were depreciating real estate over 39 and a half years, you can accelerate that depreciation into the early years. And over the first 5 or 10 years, pay a lot less income tax to own the building than to rent it.
Mm-hmm.
And that free cash flow frees up cash flow to do other things, like continue to reinvest and grow your core business, or to do other things that you want with the money by not paying Uncle Sam. I'm not making a political statement. I'm making a tax statement, and it's not a Donald Trump statement. But I believe one of the reasons, the biggest reason he did not want to release his tax returns, is because he's going to show $300, $400, $500 million of income and show very little income tax being paid. Because in real estate, you can legally do that because of accelerated depreciation.
Mm-hmm.
And it would have been embarrassing to him to release those returns. So I'm not talking about, but he did it legally within the law. We want our doctors to do it legally within the law and be able to acquire real estate, which will help them with those massive tax benefits.
Yeah. So the reason I mentioned that is because if, let's say, I've got two practices I can buy, equal revenue, equal opportunity, they're identical practices. One's close enough to merge, and one of them would be a second location, but there's a nice piece of real estate that comes with it. I would almost, the benefits of merging the location in are self-explanatory. We reviewed that. Without the real estate, that was a home run. That makes perfect sense. But when you add the real estate in the equation, that changes things just a little bit, especially if my goal is to own multiple locations, because financing is going to become a concern at some point. Banks are only going to willing to loan me so much money so quick, so fast. However, real estate is something that they really enjoy seeing on your balance sheet because it's collateral, and they can leverage that. So I would almost say that the second location with real estate would make more sense. But I don't know if it's apples to apples. And it may be a transaction specific. Maybe you got to look at each transaction independently and do the math and break it down and see which one on paper, which one shakes out to make the most sense for you based on what your 12, 24, 36, 72-month plans are.
Yeah, I think that's right. And that's why I said it. I don't think they're mutually exclusive concepts. It's going to be on a deal by deal basis.
Mm-hmm.
The other thing I'll mention on that too is that over the years, I think we talked a little bit about it, but the skill sets of being a multi-practice operator are so much different than having one location. And my clients who have been successful with a lot of locations understand the business model and being a CEO dentist and understanding how to scale and how to create stickiness with associates in different locations and so forth. My clients over the years who have not been successful trying to go multi location, they tried to kind of use the same approach that they had their first practice, which was wildly successful. And it was like, all they did was continue to stretch themselves further and further in an impossible business model. They took what worked in practice one and then tried to do it in practice two, basically putting it all on their shoulders. So they went to the point where they're working 6 days a week and then doing paperwork on Sunday and because they really didn't have the model or the skill sets to have multiple practices, and they tried to implement the same approach. So
people skills,
two very different business models.
Yeah, people skills and communication, I think, are probably the two top things that would affect an individual's ability to scale. If they don't have the leadership, communication, people skills, if they don't have those, it's going to be difficult. It's going to be a challenge for sure. Anybody can do. Any dentist can do the dentistry, and they may be a very fast, very efficient, very productive dentist. But again, you can only stretch that dentist so far. And so being able to delegate and hold accountable and communicate effectively and lead and inspire and all that kind of stuff, that's a very, 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 very important skill set to have.
Nothing more upsetting to me than to see people with multiple practices and they're mediocre at best, or somebody got one practice making money and another one breaking even and two more sucking money from the first practice. And they're killing themselves and not making any money because, that they must stand on their own, and so I would not be looking, unless there was a unique opportunity that presented myself, I would not be actively looking for a second practice until the first practice was rock solid, making cash on cash.
What would you say? I want to speak to this one too. And I actually kind of covered this a few minutes ago, but the major risks when buying a practice, what are the things that you would be most interested in looking at? For me, on the operational side, I'll tend to look at the hygiene schedule to determine if it's managed effectively, if they can get patients in a reasonable period of time, or if they've got a big bottleneck in their hygiene department. If we can alleviate that pressure on the hygiene schedule, we have significant growth potential in that practice by bringing in the additional hygiene, the additional hygienist, adding a column, and then consolidating their hygiene schedule and leveraging hygiene reactivation. There's significant growth potential in that patient base. So that's a not so much a risk as it is an opportunity for growth. Perio is another one. A lot of times what you'll see is, statistically, according to the ADA, the average general dentistry practice has about 30% perio in its patient base. And so you'll look at perio percentages and they'll be 2%, 4%. And it doesn't mean that perio is not being treated. It means it's not being coded appropriately. For whatever reason, patients didn't want to pay the additional fee, but they wanted to take care of them. So they just coded it a pro fee and, look the other way kind of thing. The problem with that is if I buy that practice, that's now my liability that I'm assuming, because that's the number one lawsuit in dentistry. So that's a significant liability. And if I start coding the perio to eliminate the liability, now I'm charging patients more and I risk attrition. Another one is how we bill and charge patients. You've got a lot of practices out there that do balance billing. And then patients wind up not paying them. And that's just kind of an acceptable standard. And if I go in and I start making patients pay their portion on the day the service is delivered, that's different. They don't like that. I risk losing patients. Fee schedule is another one. A lot of times I'll see practices that are on the market and their fee schedule doesn't even register on the NDAS or Fair Health. It's below the 40th percentile. So that's not sustainable, especially with the incoming inflation that we're expecting to experience. So I've got to make sure that my fees are in a healthy place. And if I participate in PPOs, I've got to make sure that I've negotiated fair and reasonable reimbursements on my PPOs. A lot of times I'll see practices who are actually participating in insurance plans that cost them more money to have a patient in the chair than it would cost them if the chair was empty. And so we've got to go in and look at that and see what makes the most sense for us, because that's deteriorating your bottom line, affecting your ability to reward your team, pay them fairly, provide competitive compensation so you're an attractive employer, provide health benefits and 401k match, all the stuff that makes high quality talent want to come to you. A hindered bottom line affects our ability to do that and ensure the continuity of care for patients and the continuity employment for our team. Those are probably the biggest risks that I see. And then obviously effective scheduling, and then language skills and communication. There are companies that we work with like Practice Quotient and Profitable PPOs that renegotiate insurance reimbursements. So there's a variety of different things that we do to mitigate those risks. But I say the number one thing is probably communication, because if you don't have, your team's got to be on board with whatever you do. If you go in and raise your fees on day one and your team's not supportive of that, that's not going to work out very well, because, you know, when a patient complains about the fees, they're going to reinforce, you know, that complaint with the patient because they disagreed with the decision too. So I think if you can inspire and turn your team on and get them behind the direction that the practice is headed and make sure that they're supportive of that, then I think I would welcome the risks. I would say the more risks, the more opportunity for return. So are there on the outside, because that's more like in the practice, right? On the operational side, on the outside, are there, what risks would you guys encourage your clients to avoid, or what are some mistakes that you see when people are buying practices?
I'll give you a couple from the legal side. You got to look at if there's associates in the practice, do they have non-competes or at least some kind of restrictive covenants so that they can't compete against the practice, after you've acquired it, even if their employment ends. I look at things like employment law compliance issues that, because even if you identify them, if they were favorable to the employee, but they were being done incorrectly, you run into a cultural issue when you try to fix it. So for example, when a practice misclassifies people as independent contractors when they should have been employees under the law, and then you try to go and make them employees where they're going to, have to pay taxes, they might lose some write-offs that they had and so forth. That could be a cultural issue and be a problem after you close. I also like going to buy a practice. I look at the lease. If there's a lease in place and it's not a deal that includes real estate, what does that lease look like? What are my future rights? What if I want to assign that lease in the future? Is it permissible? So those are some of the things I think about from the legal standpoint. Accounts receivable is another one that pops into mind. That is a tricky thing because you can learn a lot about a practice by looking at its account receivable numbers and how you structure acquisitions when there's a large outstanding number of accounts receivable also becomes something that is kind of technical in terms of protecting the buyer from some potential problems with having large AR balances out there. So those are some of the things I think about because I'm looking at them from the legal perspective as to what kind of risks there might be.
I'd look to see big jumps in production where an older dentist knows their patient base and they just bang out all the big work. And that's not sustainable, that they're, really a $500,000 practice, but, for a year and a half, 2 years, they bang out $900,000 or $1 million, and then they try to sell it. And it's not based on all the good strategies we talked about earlier in the call, John. It's based on just banging out a dozen big cases and, to some of their old buddies. And it's really a $500,000 practice. It's not a $900,000 practice. So I worry about that sometimes. And that's one of the reasons why I prefer an earnout, or I prefer some sort of hybrid deal so that both parties are aligned on the sale. I'm not saying you can't do a cash walkaway sale, but I think generally if you have a deal where both parties' interests are aligned, a win-win deal, those are the deals where I'm seeing not only it becomes what we refer to, John, as a class 3 experience. It's great for the patients first. It's great for the selling doctor and the buying doctor second, and the staff third, and not in that order. Staff second, and then the buying and selling doctor third. So everybody wins with that kind of transition. And then you don't have to worry about a lot of the when your interests are aligned. Then there's less chance that you can get bamboozled or have a league or other problems. When people are tied together.
I'll tell you one more that I see quite a bit of is there's a number that I calculate called crown to filling ratio. And essentially, I'm not a clinician. I'm an analyst. Essentially, I like looking at numbers and trends and math, and I like trying to assess the health of that business. And so that's a really good assessment of the clinical nature of the doctor and the clinical philosophy, because what it tells me is how progressive they are, how proactive versus reactive they are in their treatment planning. It's a really good indication if there's a lot of watching going on in the patient base, or it's a really good indication of what the clinical background of the doctor is. If you've got a highly trained that doctor who's attended a lot of postgraduate CE, depending on what courses they went through, that number is going to change drastically. And you'll see anything from, 1 to 1. I've seen as low as like 0.4 to 1, 0.5 to 1. I've seen as high as like 6 and 7 to 1. And the reason that's important is because if I'm the 0.5, if I'm the 1 to 1 doctor, and about 1 to 1, I'd say about 1.5 is 1.25 to 1.5 is a pretty typical number. Your typical average, general practitioner might be anywhere from 1.25 to 1.75 to 1, which means they're doing 1 crown to every 1.25 to 1.75, 3 and 4 surface fillings. Okay. And so if I'm the 1.5 doctor and I'm buying a practice that that the doctor who's selling the practice is a 6 to 1, then I'm nowhere near as productive per patient as that doctor is. And even though the practice is doing $1 million when I buy it, the revenue is going down as soon as I buy it. The other thing is procedure mix. If that doctor's doing procedures that I don't do, that's something I certainly need to take into consideration. I've actually got a client who called me after he bought a practice, because he bought a practice for like 6 or 7. The practice was doing like $700,000 or $800,000 in collections. He bought it, and it was like 60% of the restorative revenue was implant revenue, and he doesn't place implants. So on day one, that practice went from $700,000 to $300,000, $400,000. One of my clients referred me to him. We've done a merger acquisition. Got some really good people. I think he's going to hit $1 million this year, so he's doing really good. And he's looking for another M&A. So procedure mix is another really important one. But clinical philosophy is a big one. If I'm the 6 to 1 doctor and I'm buying a practice from a 1 to 1 doctor, I'm fixing to hit a home run, because that means there's a lot of dentistry that I do, or I'm a lot more proactive in terms of my approach to tooth decay than the doctor of the practice that I'm buying. And it's not a right or a wrong or a good or a bad. I don't want to put that context around it. It's just if you put a patient who has decay on number 30 in front of two dentists are going to have 2 different treatment plans. So it's the clinical subjectivity is what is the freedom of private practice. That's what you get in private practice that you don't get in corporate dentistry, right? And so that's what makes you. So it's not a right or wrong or good or a bad. It's just it's different. You just need to be aware of what those differences are, because they can either cost you a lot of money or make you a lot of money. Very good. What would you say are some considerations when we're going from 1 location to 2 locations? Okay. Anything that I would need to take in consideration before I do that, or any considerations regarding financing? If my goal is to go from 1 location to 5, what do I need to be looking at in terms of, how am I going to get financing? Where am I going to run into some roadblocks with financing? What advice would you give me there?
I'll just mention one thing in particular, because I've seen it happen to a number of clients who have those goals. It is, first of all, you have to align with a lender who understands your business plan, who understands that your goal is to borrow a lot more money and to scale and grow, and that you'd like to have a partner in a lender who it wants to grow with you. Seen it happen to clients a number of times where the lender's interested in deal number one, but they're really not interested in multiple deals. Some lenders have lending limits per borrower. That's an important question to ask. You're talking to a lender, how deep do they want to go with you? If you find out that they only want to go up to $3 million or $4 million with one borrower, and you have a business plan to own 5, 6, 7, 8 practices, it's the wrong lender. So the other thing I'll mention too, when you want to have multiple practices and you want to finance, is they're going to look for track record. When you go from 1 to 2, they're not going to want to finance practice number 3, 3 months later. They're going to want to see, how did you do going from practice 1 to 2? They're going to want to see a year, usually, of financials to show that your special sauce from practice 1 still applies to practice 2, and that you've got that practice running well and profitably, and that it's secure and it's stabilized and doing well. Then they'll lend practice 3. And a lot of times at that point, they want to wait a year and see how practice 3 does, to make sure that before they keep throwing money at you, that you're able to scale and that you understand how to run that business model. So those are some thoughts, at least on someone who's looking to grow and to finance with a bank, that you have to think about.
And I would just add also, you don't want them to, some of the banks do such a great job at tying up all your collateral that even if they won't do business with you, they don't want to do the second or the third or the fourth practice. They've got you so tied up that you can't even go to another bank. Mm-hmm. And you're in trouble. So part of it, I think, John, is it's the technology out there. I think the people that try to go it alone and just try to do it, it's not like, guys like Bill and I have done this literally thousands of times. You've done it thousands of times. I've been doing this for so long. And so the idea is there's experienced people that this is all they do for a living. And it's like, how many people, come back to you, John, or come back to you, Bill, and say, and they come back to you after the deed's been done and all the problems are there. And it's almost like, well, if you just would have come and just gotten some advice, it's not hard, it's not difficult, but there's a path to navigate all of these things and do it in both elegance and excellence, rather than trying to dig out from something that sometimes you can't after you've committed yourself in the wrong way.
Yeah, I like it. Operationally, I think I would just contribute making sure the track is laid before the train gets there. And so if your plan is to scale and add multiple locations, you need to be thinking about personnel and the infrastructure that you have in place to support that kind of growth. Like when is the appropriate time to hire a high-powered $100,000 a year practice administrator that can manage and hire and fire and negotiate and do a lot of the things that need to be done if your choice is to continue to be the practicing dentist and not the facilitator of those business moves. So just making sure you've got the team around you. And I would say your board members, making sure you've got your coach, your financial advisor, your insurance agent, your attorney, your CPA, making sure all those people are aligned to understand what you're doing, where you're headed, your board of advisors, and then making sure that you've got the personnel infrastructure in place to support that growth rather than running out of track and stifling the momentum that your enterprise is having at the moment, and having to wait for 6 months until you find the right person to plug in there before you can take off again. I mean, I would put that person in place first, so that they can just basically be a catalyst for future growth and development. Okay, good. So as we're going from one location to second location, an obvious, consideration comes up, and that is finding associates to plug into those locations. And so with it's interesting. I've got a couple of different associate ads running at the moment, have been running for 2 to 3 months. And the level of interest that I'm getting in those ads is a fraction of what it was just 12, 24 months ago. And so it's the talent pool is definitely not where it was. I would say it takes a little bit more effort and creativity to be attractive to some of these folks. What are you guys seeing in terms of where people are successful in finding associates? Generally, I know.
Well,
generally,
I was going.
Go ahead.
Sorry, John. Go ahead. I cut you off. A little delay. Take delay.
I was just going to say, generally, there are like 3 places that you're going to find associates. One of them is going to be job ads. And a lot of those, I'd say 80% of those candidates are going to be like fresh grads. They're going to be, foreign exchange, those kinds of individuals. Referrals from your network is a really good place to look. Typically, you're going to find higher quality associates come from those individuals. And recruiters are effective in finding associates. But I mean, sometimes you leverage all 3 of those platforms and you're still coming up empty-handed. Is there anything outside of those strategies that you're seeing people use to find quality talent?
Yeah. Well, first of all, I'd like to make a big differential between when you talk about recruiting. There are people that pretend to be in the recruiting business, and they're not really recruiting. They're just searching the web, searching Indeed and job sites and the schools and everything like that. In every industry other than dentistry, they're doing retained searches where they're actually going out and really recruiting people that would be the right people for your practice. And that's not only doctors. It's now reached down because of the scarcity of people to hygienists and even to executives in your organization. So I think that's different. I think the other thing will come in dentistry is that there are people, and again, I always say, people always say if you're in my company, John, and you say we're in the financial services business because because of what we do. If I ask you what do we, what business are we in, and you say we're in the financial services business, you know what that gets you, John? It gets you a severance check. Because we're in the people business, and as long as the patients and the clients are people, as long as the people we work with are people, we're in the people business. And I think we're going to have to open up a new front because there's people that are people, and these good paying jobs in dentistry. I think we've got to start to recruit another group of people that might have gone into other industries or might have done other things and get them into our business. Because I think we're in the people business, and I think we do pay well. We do pay well, particularly like as a hygienist. I mean, to me that's a high paying job for an awful lot of people. Mm-hmm. And I think we've got to do a job as an industry at attracting those people to this industry.
Very good, Bill. Are you seeing anything creative on the associate front, like how people are finding associates, or is it just the traditional platforms?
Well, I'll just add one thing. I've seen some clients of mine who have relationships with friends that teach in residency programs, and they get direct access to residents who are getting ready and thinking about their first move, and getting that warm introduction from someone who's working in a residency program to the residents is a really great thing. So if you have, again, it kind of goes back to like networking and connections, but I've seen that work for a few of my clients where friends of theirs, classmates from dental school, who now are working in residency programs and teaching, getting access to their residents is a good opportunity when you can and have that conversation. It's getting hard. It's harder because the thing you have also in the world of recruiting is DSOs are going directly to the schools, mm-hmm. and they are wining and dining and throwing parties and offering different programs, loan forgiveness programs and sign-on bonuses and things like that. And so the competition for the talent, I think, is becoming greater and greater.
Yeah, that's actually the next thing that I want to jump into. But before I do, I want to contribute one thought here. And that's, I think a lot of people are, and this is the same thing for employees. I see the same thing with associates. They sit on the sidelines and they wait for the right person. They wait for that, rock star associate that does implants and bone grafting and IV sedation and molar endo and third molar extractions. They're waiting on that person that can come in and just add all this stuff to the practice, like the the benefit of that associate completely outweighs the expense. And a lot of times we keep positions open in our practice because we're just looking for that right person. I agree and I disagree with that. If you ask me who the right person is, I would say someone with comparable values, beliefs, and rules. Someone with the right attitude is the right person. The skill set is going to be learned and acquired and trained over time. You do not have a rock star dentist that got there completely 100% on their own. They were in a practice that put a lot of pressure on them and required them to get their hand speed up. They were with a great clinical mentor that taught them some tricks and tips. And, they had great leadership that got them to that point. And so I think it's necessary for all of us to consider maybe part of our responsibility is to be that great leader for somebody and help them develop and get to the next level. Because if I'm a level 5 leader and I hire an associate who's coming from a level 10, that associate's not going to be with me very long. It doesn't matter how much I pay him, because he deserves better. If I'm a level 10 and he's coming from a level 5, then I create an opportunity for him to further develop and get better, faster, more efficient, more productive, et cetera. So we're talking about, like, when we look at the statistics and the studies on job satisfaction, the number one variable that people mention is fulfillment and being and fully utilizing the skills that I have to offer, fully utilizing my talent. And so that's what this whole conversation is about, is creating a platform or creating an environment where people have the opportunity to grow and then giving them the resources and the leadership they need to do so. And so I think we've got to be open to the idea that maybe that peak performer may not be there. Maybe that peak performer is in a practice and they're happy, but there are plenty of enthusiastic beginners out there who are looking for the right practice. They're just looking for someone to lead them and help them develop, who can become amazing associates, who could become a future partner. But if I never give them an opportunity because they're not the quote unquote right person, they're not doing implants yet, I could completely miss out on a pretty significant opportunity long term. So I think that's an important thing to consider. And Bill, you broached the next topic, which is how can private practices compete with some of these DSO offers with loan forgiveness and relocation stipends and sign-on bonuses. And I've even seen, I've got a client who's interviewing an associate now in Georgia who works for Aspen. And when he negotiated his relationship with Aspen, he negotiated no non-compete. So he can leave tomorrow and walk across the street and see patients. So kudos for him. But as a private practitioner, I don't know that I'm moving forward without a non-compete. So I can't compete with that. So how do these guys compete with the DSOs for associates?
Yeah. Well, I think that appealing to the entrepreneurial associate, someone who wants to be an owner in a practice, I think that private practitioners can create opportunities for partnership for an associate. And, that I think, again, for the right candidate who really wants to be an owner and doesn't want to be tied into corporate, that could be very attractive. And Mark has some terrific strategies that we've seen work really well at retention with some deferred compensation concepts. Mark, maybe you should talk a little bit about that, because that's worked really well for a number of clients.
I mean, I think you got a number of options. One is you can sell equity. You can sell equity to people, minority equity. But I think there's an awful lot of people out there that I'm finding, particularly younger folks, that don't want to sign on to the debt. They don't want to sign on to the lease. They just want to come and do a good job, but they want to be more than associates. They want to have a home. They want to feel like they belong. They want to feel like it's their business. And so oftentimes what we've done, John, is put agreements together that could drive the objectives of the company so that most of the bonus is paid by their productivity. We also have a retention bonus in there. But the important thing is they must stay a long time, typically up to 10 years, to get the full amount of money. And so it's sort of what, and when you're talking to the owner, we call it a golden handcuff plan, because we're taking their best people and handcuffing them with gold to the business for as long as we possibly can. For the employee, we refer to it as the long-term incentive plan. But if they stay and help us grow the business, it will look and talk and smell like equity. And the money will be largely been created by their increased productivity and meeting the objectives of the firm.
Mm-hmm.
And that's another alternative. We find that very very attractive. And we've been, between Bill and I and our firms, we've been doing dozens of these going forward.
Yeah, I think a big part of the incentive, like Bill said, is the entrepreneurial dentist. And so when you mention equity or partnership opportunity or potential buy-in down the road, that's really attractive to me, right? As an entrepreneurial dentist, that's really attractive to me because I want to own. But now you've got some DSOs who are getting a little creative, and they've got programs or models in place that allow the associates to own equity in the practice or own equity in the DSO. It's not the same as it would be, having equity in a private practice. But I mean, are you seeing that too?
Here's what I would say, John. I think that, and by the way, I'm also okay if the DSOs want to go out and train the industry, and they want to go out there and get people to work there for 2 years, 3 years, 4 years, give them a good salary, give them, in an environment. But again, I don't think most private practitioners are looking for everyone. They're looking for somebody that wants to be their own boss, wants to make their own hours, wants to have skin in the game, wants to create equity, wants to not just live by a paycheck, but wants to create wealth. And so those people that are entrepreneurial thinking folks, they don't have to find their way to an entrepreneurial practice day one. Some of them are taking 2 or 3 years. And so the best candidates we're getting are people that are in business for 3 to 10 years. And they figured out that, hey, I'm making a nice living, but by the time I pay my taxes and pay my bills, maybe I put a few bucks in a 401k plan. I haven't really done much to create wealth. And I still got a lot of student loans. And it's now time for me to go make money because now I've got good skills. And then, obviously what we do is we want them to not only be in fact, I have a book coming out in December or maybe January. I just finished it. It's the entrepreneurial mindset. And I think the subtitle will be going from being the great artist to becoming the great CEO, or maybe the great leader. Maybe you're not the CEO, but you're a leader in your practice or an owner. And I think that's where that's where people who want to create wealth go. People who want to create a living stay in the DSO world. And I think that they're giving people some equity in some practices, but they're not creating. I'm not seeing a lot of models where they're creating the kind of wealth that they can create on their own.
Yeah, and I'll tack on to that not all equity is created equal, right? So, John, to your point, I think you were alluding to it, is when you're a private practitioner and you give an associate an opportunity for equity, in most cases, you're giving them real equity, right? They're actually buying in to the same type of ownership that you have. Now, maybe they have a minority interest, but they have real equity. They own a piece of that practice. And if you look at the fine print on a lot of the DSO deals, when they're offering equity, they're really offering a profits interest. Mm-hmm. And a profits interest, they can give it to them because the whole concept of a profits interest is whatever's been created to date, you don't really have an interest in that, right? So let's say the valuation of a practice is $2 million. Your profits interest gets you a share of what grows beyond the $2 million. So the value that exists to date, you have nothing to do with in these types of arrangements. A lot of times, not in every case, but so you have no voting rights. You basically have no rights at all, except for some share of the future profits if the practice is successful. So that's a different type of equity opportunity than buying in and becoming a side-by-side partner with someone in a private practice.
Yeah, it's a risk reversal. I only pay you if the number goes up. If you improve.
I think it's more about locking in top talent than it's about creating wealth for that associate. And I think sometimes they don't understand that.
Yeah.
Remember, most people are not entrepreneurs. Most people in every business, not just dentistry, bought themselves a job. And so, part of it is lifting them up and showing them there's a way to create abundance for them, create, great real wealth. And if they do it right, remember, why does private equity want to be in dentistry? It's because they're not care about the healthcare, or they're not physicians, the masculatory system. They're doing it because you can create real wealth. And there's the tools and techniques out there for virtually every doctor to create multi-generational wealth if they'll work along the ways that we suggest that they do. Mm-hmm. I mean, remember, unlike my NFL players, I'm an NFL registry player financial advisor. You've heard me say that a million times. They have 3.5-year careers with non-guaranteed contracts.
Mm-hmm.
These folks have 20, 30, 40-year careers. And what's beautiful about dentistry right now, some of our most successful dentists that we all work with are no longer chairside doctors. They don't put their hands in people's mouths, but they're making more money than they've ever made because they get paid for what they know, not what they do. They're entrepreneurs, not entrepreneurs. Right. And that's basically our business, is showing people how to really become entrepreneurs and entrepreneurial thinking. John, you got a lot of good questions. There's some people. I even see a few friends on the board. And can we open up questions? Can we open it up for questions so we can
sure.
get these good folks involved?
I haven't seen any in the chat just yet. So, guys, if you got any questions or comments, please feel free to drop those in the.
Can they open up their mics and we can give them a chance to shake it up a little bit?
Let's see. I don't know if I can. Let me see if I can do that. I can. If so, well, they need to raise their hand, so I know who to unmute. Otherwise, we're going to have a bunch of dogs barking and kids crying in the background.
I'm okay with that. That's the post-pandemic world. If you don't see, half the time you're looking to see if they made their bed, or if they're, if they've cleaned their house, or
It's interesting. Yeah. There's one group that's out there now that I've seen. One of the things that they're doing. And they approached one of my clients with the deal, and what they presented to them was that they were going to essentially buy part of the practice over a period of time, and then the other part of the practice they were going to trade them equity in the DSO, and they were trying to sell them on the idea that this DSO is going to get rolled up into a bigger DSO down the road, and the real payday is when they sell, which may or may not be true. But I mean, that's a bit. If I do that deal, that's a pretty big risk I'm taking. So it's interesting. It's interesting to see how creative these guys are getting to pull some of these guys in.
Yeah, but it's like, again, but it's like any other business. It's going to be half of these DSOs, or a portion of the DSOs, are going to knock it out of the park and do well and have a bigger, better payday, and a portion of them will not have a bigger, better payday, and a portion of them will go under. Will not have a payday at all. I mean, I think it's like, by definition, just because you have DSO in front of you does not mean you'll be successful. And many of them will be very successful, and many of them will be very unsuccessful.
Mm-hmm.
Just like in dentistry. I mean, why do you have private practitioners taking home $2, $3, $4, $5 million, and you have other people that there are other people taking home $40,000 or $50,000 a year? They both have DDS or DMD after their name.
Yeah. Are there any? So we talked a little bit about.
I was going to say, John, but to me, here's the question that Bill and I and you have been asked 10,000 times. It's been asked 10,000 times us in one form or another, and there's a book out about it now that basically captured our business in this book. And the question has been that we've been asked 10,000 times is, how do I grow my business? How do I grow my income? How do I grow my freedom of time? How do I grow my freedom of relationship? It's wrapped around in one of those questions. And we've always thought that was the wrong question. And the right question has always been not how, but who. Who do I need to collaborate with to grow my income? Who do I need to collaborate with to grow my business? Who do I need to collaborate with to grow my freedom of time, freedom of relationships? And that's the right question. That's the game changer. And you take it one step further. And I've said, I used to hear people say when I first came into business, John, and I'd love to hear Bill's comment on it because he's done a lot of thinking about this as well, and we've talked about it. But people used to always say to me, all I want is a level playing field. And I used to say to myself, that sounds so ridiculous to me, John. Who the hell wants a level playing field? I want to run straight downhill. And now I think that's even ridiculous, John. I think what we want to do is help each and every person not run straight downhill, but play in a competition-free zone where the only place that patient can get that experience is working with their practice and working with them. And that's what we're trying to do out there. That's the entire game, set, and match. Bill, what would you add to that?
I'm not sure if there is anything to add to that. I mean, that's really at the end of the day what it's all about. And I think that my only comment that I'll make is private practice dentistry is here to stay, and you can be incredibly successful and do very, very well. DSOs are not a thing to be afraid of. Mm-hmm. If anything, I like to try to look at what is it that they do well, because it's not all bad, right? I mean, there's a reason why there's some success there. And what things can our private practitioners borrow from what's happening with private equity and DSOs? What kind of things can we borrow that can enhance our practice or maybe make us better or a little more profitable? Things like having having specialists in the office, or having expanded hours, expanded days, technology, same day dentistry. Like, there's a lot of things that we can have our own playbook and perform at a high level and be independent, but borrow enough things that we see succeed in some of these practices that have scaled or in DSOs, and where appropriate, implement them in our practices. And I think that that's something that I would add in terms of, I tell people, like, don't be afraid of DSOs. Understand that they're in your market. Understand that they are part of your competition, but also look at what are some things that you might borrow from their playbook that would be beneficial for your practice.
It's good to have contrast. It's really good to have contrast. It's good to have somebody that's really good at this thing but not so good at that. Like DSO, really good at systems, efficiency, affordability, convenience. Hit a home run on all of those. Bedside manner, customer service, patient communication, education, probably not on the same level as a highly trained fee-for-service private practice. There's a lot of contrast there. So, know what they're good at. And just like Bill said, take some tips out of take some tools out of their toolkit. But at the end of the day, focus on what differentiates you and what sets you apart in the market, rather than trying to compete with them and play their game. You can't. I'm reminded by an example of a gym here in my hometown that's privately owned, and some guys bought it, and Planet Fitness opened up down the road right after they bought it. And the very first thing that they did was cut their fees. And I was like, guys, that's insane. That's the worst thing you could possibly done. I mean, Planet Fitness has brand new equipment. They've got a nice brand new facility, nice build out, clean environment, all that kind of stuff. You've got old equipment, old school bodybuilding equipment, dirty locker room, right? Stained ceiling tiles. So you can't, I mean, it's different. You're not going to charge $15 and get the person that wants to pay $15 to go to the gym. You've got a very, very specific style of equipment here. You need to appeal to the people that want a real hardcore, old school bodybuilding type environment. And they'll pay more for that environment than they would to go to a clean Planet Fitness. So you don't need to charge more or charge less. You need to charge more, and you need to buy more equipment that appeals to the people that will pay more to go to a good gym. So it's the same concept here. It's what are you really good at, and focus more on that rather than trying to compete with somebody who does things better than you and probably will always be better at those things than you.
John, that's brilliant. That's so spot on, John. That's really great stuff.
Mm-hmm. And so since we're talking about, Bill, you mentioned partners, and I think Mark talked a little bit about structure and associate buy-ins. I don't know how deep we want to go into that. I want to make sure that we save plenty of time for the DSO portion of the conversation. Anything that you would add about when is the appropriate time to bring in a partner? When is that the right time? And how, what are some different ways that you could potentially structure that?
Mark, you want to take the right time part, and I'll talk about the structure.
I think I think the right time to me is always when, to me, a lot of times bringing in a partner to me, first of all, is not about bringing in a partner. It's about locking in top talent.
Mm-hmm.
We've already said there's a shortage of dentists. So if you've got somebody that is rocking and rolling and you're making money, you want to lock them into your organization by bringing them in as a partner. I mean, obviously, the obvious time is when you're looking to begin your transition into retirement. Obviously, that makes sense. It also makes sense probably when you have at least a 2-week backup in your schedule so the new patients can't get into the schedule. But I don't look at it from like the clinical place. I look at it from the money place and say, do we have the ability, there's, with all the marketing we have, with all the technology, with all the other things, if you find the right people, we can figure out how to get them really productive really quickly so that everybody makes more money together. Again, a win-win strategy.
Yeah. And on the structure side, obviously all partnership buy-ins start with understanding what's the value, what exactly is the value of what we're going to sell, and how much are we going to sell, right? Where are we starting out? Are we starting out with a small minority interest? And how much is it gonna be sold for? And are we gonna finance it with a bank, or are we gonna hold is the seller gonna hold a note? But a lot of times, even when you establish value and you try to get your arms around how much you want to sell, an earlier point that you made was, if I'm going to be buying in, let's say I'm an associate in the practice and I'm getting 30% of my collectible production, and I'm making X dollars a year, right? I'll put a number on it. I'm making $180,000 a year. It's not going to be attractive for me for a buy-in, regardless of what the value is and everything else. If we say, hey, Bill, you're going to buy 20% for this price, and after your debt service and your share of the profits, you're going to make $160,000 a year. Congratulations. You just bought in, and for the next 10 years, you'll make less money than you're making as an associate. That's not going to appeal to someone. In some respects, especially with interest rates being as low as they are right now, you can kind of, especially when you're really trying to retain somebody, or you have an excellent top talent and you want to make sure they stay, you can kind of back into a fair arrangement and kind of, work your way to a point where you do a pro forma, and based on how much they buy and at what value, they're at least making as much or more than they were making as an associate, so that it makes sense and it's appealing to be an owner. And I do appreciate that when you amortize that buy-in down, and it's, X amount of years, 5, 7, 10 years later, and you've paid off that equity, that initial buy-in. I do appreciate that at that point you might have a precipitous jump in income, but the average young associate doesn't want to wait, 5, 7, 10 years before they actually get to a better place than they were as an associate. Mm-hmm. So you kind of have to back into, on some level, a pro forma that makes economic sense for them. Does that make sense to you?
Makes a lot of sense.
And by the way, if you can do it, by the way, Bill, not only make a little money in the get-go, but let's say you got a practice and the practice is worth, you pay that down, and now the practice, because it's grown and you've paid off the debt, and now you got an asset worth $1 million. How many years do people have to save to put $1 million away? Most people don't do that in a lifetime.
Mm-hmm. Yeah,
that's a great point.
So good. I'm glad we got the time that we've got. So because I need to make this disclaimer or statement. So essentially the breakdown of the talking points here is, when is it an appropriate time to form a DSO? What exactly is a DSO? What are the benefits of structuring it, and how to do that? If you want to know the answer to those questions, you're going to have to buy Bill's new book, The DSO Decision. I appreciate you guys joining us this evening. I'm just kidding. So, Bill, I know that's right down your alley. So sure. If you could just kind of give us an overview on what these guys need to know about
sure.
DSOs.
And it's interesting. I get a lot of calls where people call up and they say, I need to set up a DSO. And I'll say, okay, we love doing legal work. That's great. But, why do you need to set up a DSO? And sometimes it's, well, a friend of mine told me I should set up a DSO, or, I'm going to have 2 practices now, so I have to have a DSO. And the truth is, as much as I love doing legal work and we love setting up DSOs, there's really only a small handful of scenarios when it's, quote, time where you really need to set up your own. One is if you want to bring in outside non-licensed investment, right? So let's say I have a friend who's an entrepreneur and they are been looking at dentistry and they feel like it's a great place to put money, but they're not a licensed dentist. Okay. And they want to invest and maybe I want their money to, whether it's to grow my existing practice or acquire another practice, because in all but a small handful of states, and in the book, I go through which states in particular. It's like 6 or 8 states where you either can, a non-licensed person can own a portion of a dental practice, a lot of times a non-controlling interest. There's a couple of states where, like Pennsylvania, where it is allowed, where a non-licensed person can have an ownership interest. But truthfully, in most states, it's forbidden. You can't own a piece of a dental practice. So the way to get around that is through setting up a non-clinical business entity, okay, not a practice entity, but a business entity, which is the DSO, dental service organization, dental support organization. That's what the acronym stands for. And you can, through a series of regulatory compliant contracts, I won't get into all the complexities of organizing a DSO, but through regulatory compliant contracts, you can set up a scenario where people can invest in you without breaking the rules. The money can flow, again, through a series of agreements that have to be set up a certain way into the DSO, and they can get a return on their investment and profit from being involved in the ownership indirectly of the dental practice. A second scenario when you would consider setting one up is, let's say you have non-licensed people on your team that are very important. Maybe it's an operations person who's running the operation, or a key office manager. I have a client right now who he's on to his second large practice and he really wants to scale and grow, and he hired a CFO to work with him. And, he wants him to be able to have equity and a vested interest in the growth of the business. So we're setting up a DSO so that he can reward people that are already on the inside by giving them equity. And that's a way that he can reward them. So that's another scenario. And then the third scenario would be that you're scaling to a point where it makes sense to centralize a lot of your services within one business entity. Maybe that's payroll, maybe it's marketing, maybe it's all of your billing and collecting, and you want to actually create one business that provides all the services to your practices and consolidate it and put all the employees. In most states, you can put anyone but the doctors in the DSO payroll. Some states, the divide is clinical versus non-clinical as to who can actually be employed by the DSO. So that third scenario is a scenario where you've decided, because you've scaled and you're getting larger, you're looking to centralize those services in one business entity. So outside investor money coming in, rewarding people that are non-licensed, who are on the inside, that you want them to have an opportunity to really participate in equity, or centralization of services because you've scaled and gotten larger and there's a business reason for doing it. Those are really the only, real pressing reasons why an independent private practitioner would think or look to structure a DSO.
Fantastic. And then, so the benefits are pretty self-explanatory from what you just said. It's more efficient when you centralize, more financially cost-effective, gives you an opportunity to reward key employees, allows opportunities for outside investment from non-clinical personnel. Very good. And then obviously just structuring a DSO, that's a pretty complex thing to accomplish. So they would need to hire somebody who's like your firm, for example, does a ton of DSOs. How long does that process typically take?
So it depends. There are some states where you actually have not only you have to prepare all the documents in a regulatory compliant way, but some states you actually have to submit the documents through the Board of Dentistry and actually have them approved before you can start your DSO. That's not a lot of states; it's a minority of states, but so that can take longer because their review process could take several weeks. But typically, if we have an active compliant client who's like answering the questions when asked and providing the information we need when we ask for it, the process from inception to having a DSO ready to go and ready to perform, it could be done within 2 to 4 weeks. Again, depending on how busy the client is and they're able to set time aside to work with us on that. But it could be a relatively quick process. And we've done them as quickly as, 10 days when somebody needed to put it together very quickly.
Very good. Fantastic, gentlemen. I think we've beat these talking points to death this evening. I'm truly grateful for the time. This is why I like setting these things up, is because I get free legal and financial advice. So I'm just going to schedule one of these a month so I can jump on the phone with Bill and Mark. They make sure I point it in the right direction. But incredibly grateful for your time this evening and your insights. Any final thoughts for our audience this evening?
We just appreciate you and putting this stuff together and just doing some great work. You're a force of nature out there, John, and just keep it up.
I did my best, man.
Yeah, you're doing a great job. It's always fun chatting with you, and as much as we like to hopefully pass on some wisdom, I always learn something every time I'm on the phone with you. My knowledge of dentistry and the business of it gets a little deeper. So thanks for having me participate.
That's the goal, man. It's why I was really inspired to start doing these things. It was why I was really inspired to launch my podcast and get those up and running. I will do a shameful plug on my podcasts. If you guys are on YouTube or on Apple Podcasts, Google Podcasts, Spotify, any of those, look up 21st Century Dentistry, and then also look up Real Dental Podcast. And so 21st Century Dentistry is essentially where I interview, really intelligent and experienced professionals like Mark and Bill. By the way, I need to get with both of you guys so that I can have you on there. And just an interview format and getting to know them a little bit better and how they got into their career and what their experience has been and all that good stuff. And then the Real Dental Podcast is me, and typically it's just 3 or 4 of our coaches here in the Mid-South. And what kind of obstacles we run into our clients, what our advice is, what we're seeing in terms of results and that kind of stuff. But just a pretty casual format, pretty casual discussion. And I was really inspired to do that because it was, I might run into Mark at Platinum Circle or Fortune 50 or Bill at Fortune 50, and we would sit and have a conversation. And during that conversation, I'm like, man, I wish I had recorded that, because there was so much good, insightful, thoughtful content that came in that showed up in that discussion. And I'm like, man, I wish I had recorded that. And so I was like, well, why don't I just start recording it then? And so I started doing a lot more of these virtual events. I started doing, it took me 2 years to get my podcast off the ground, but finally got those up and running. And it's great for me. It's almost selfish for me, man, because I do it and I bring people on that I want to learn from. And I guess the thought is that if I want to learn from them, I know there's other people that want to learn from them too. And so I do it in an event format to give them an opportunity to learn. And so it's always been beneficial for me. And I hope I'm confident that it's beneficial for anybody that tunes in. So with that said, we will have this up and running on YouTube here, probably whenever my production company gets done with it. It'll be on our YouTube, my YouTube channel, which is just John Harris. You're welcome to check it out there. And then if these guys are willing, look for Bill and Mark to show up on 21st Century Dentistry some point here in the near future. I appreciate you guys tuning in this evening. Bill and Mark, grateful for your time, and I look forward to seeing everybody soon.